think that there is a way out on this one, and it's a dangerous one, and that is for Russia to destroy the dollar, which it can do. Russia could go on a gold standard tomorrow and expose that fiat currency for what it is, and that would be the end of the dollar, and quite quickly too. I mean, you can imagine the legion, if you like, of BRICS and Shanghai Cooperation Organization members, their affiliates and associates. We're looking at 60% of the world's population, or nations representing 60% of the world's population, turning against the dollar in one swift move. It will be the end of the dollar. It will be the end of every dependent currency, fiat currency, unless they are prepared to embrace the gold standard.
Alasdair Macleod is here to join us today. Alasdair, thank you so much for coming on for the first time.
That's my pleasure, Danny.
So for people who may not know who you are, Alasdair, I know the one or two out there who may not know, give us a little bit of a rundown on who you are. What got you into investing, macroeconomics, the gambit?
Well, I'm getting old. I started as a stockbroker in 1970. And I've been a stockbroker, I've been an investment manager, I've been a banker, all at senior levels. I've really been out of the investment game now for 25 years, I suppose, almost. Instead, I enjoy observing the world, looking at it from the point of view of economics, analyzing money and credit, and particularly precious metals, which I have always had a bent towards, but later got to realize exactly why it is money and everything else is credit through my learning, as it were. And it's really, I want to pass this on to people, because if you don't understand what gold and silver are in the monetary sense, then you are very vulnerable to the whims, if you like, of the valuation of credit, which include currencies. And to do this, initially I started writing for Gold Money. I still write for Gold Money, but this year I've set up my own Substack, because I do believe that if people actually join a specific site with a specific objective and are prepared to pay a little bit of money, like a couple of Starbucks coffees a month, as it were, then I think that they will be conditioned actually to pay attention, learn, understand. So that's really my mission. That's where I am today.
Yeah. So kind of what is your 60,000 foot view look at the market at the moment? What's really going on in the market, from your standpoint?
Well, I think the easiest way to describe it, and I'm sure we'll go into a bit more detail as we progress, but the easiest way to describe it is that this is really looking very much like a repeat of the 1970s, rather than the period of the last few decades when we have seen interest rates go low, be suppressed low, without any apparent consequences. The 70s were very important because that gave rise to stagflation, a term incidentally invented by my uncle when he was opposition. He was the shadow chancellor in 1960s, late 60s. So, inflation is not going away. And so therefore, lower interest rates are not going to stay, they're not going back to low interest rates. I mean, may get a cut or so, but I mean, the reality is that interest rates will rise over the rest of this decade, and they could rise a lot more quickly than they did in the 1970s. And there is a further problem, again, looking from 60,000 feet, and that is the level of indebtedness of governments, and particularly the US government, with a debt to GDP running at 130% or thereabouts. The problem I think they have is that the foreigners are no longer buying dollars, and they are the people who will price government debt, US treasuries, at the margin. And if they're not playing ball, then these yields are going to rise. And the more they rise, the more the US government is in a debt trap from which it just cannot escape. Well, it can if it was prepared to take the political decisions to cut spending, to the degree where there was a surplus on the balance of payments, sorry, on the budget balance, and that would also, incidentally, go a long way to correcting the balance of trade. Now, under those circumstances, there could be some recovery in the dollar, but there's no way that's going to happen. I think we can agree on that at the outset.
Yeah. So looking back at history, when countries get to this point of 130% debt to GDP ratio levels, what is typically the outcome? What comes after that? Once you reach that kind of threshold?
Well, a couple of economists, I'm trying to remember their names. One of them was Carmen Reinhardt. I'm trying to remember the name of the other one. It'll come to me in a moment. Did an analysis of this and came to the conclusion that if government debt to GDP exceeded 90%, there was probably no hope. So at 130, I mean, we are well into no hope territory. And it's not just the US. I mean, the UK is looking at 100%. France is looking at about, 110%. Italy is about 150%. Greece has come down a bit because GDP has recovered rather than they've actually cut their debt. Countries like Portugal, Spain, all the rest of it, I mean, they're all actually basket cases. This is actually a very dangerous situation. It's not just the US, it's the whole of Europe. And, not to mention Japan. I mean, that's crazy. That's 260 odd percent of GDP, their government debt. So there's no wonder that the Bank of Japan is trying to resist the rise in bond yields. Apart from anything else, it owns 60% of Japan's government debt. So it is actually not just insolvent; it is bust. I mean, the directors, if you like, of the bank, if they were a private enterprise, would be in jail for behaving the way they do. But it's a government department, so different rules apply. But I can tell you, it's not just that. The whole of the banking system is in real difficulty. The Bank of Japan, as I've said, is the equity is wiped out many, many times over. I think that the Fed's problems have been well broadcast. The Bank of England doesn't have this problem directly because a previous governor very sensibly persuaded the Treasury to undertake any losses on quantitative easing. So the Treasury is stuck with the bill, but you know what's going to happen. They're going to come knocking on the bank's door, say, hey, we need the money, raise more money. So it's still there. The ECB and the network of national central banks, I mean, that is an almighty mess. I can tell you how to recapitalize a central bank. It's very, very easy to do. But when you've got a network of banks, central banks, which in turn are the key holders, in other words, shareholders of the ECB, for the ECB to be recapitalized requires probably the majority of its shareholders, the national central banks, to go to their parliaments for permission to raise the money to recapitalize the ECB and at the same time recapitalize themselves. I mean, I can see this getting into real difficulties, and it's it could be the end of the euro, and I do not exaggerate. It's a very, very serious situation. Another point I'd make from this 60,000 feet position is the geopolitics. America is losing its power. This is notable, particularly in the way in which the dollar is being used less internationally. China and Russia, between them, are determined to do away with the dollar as much as possible. And so they're accepting each other's currencies. In the planning stage, they hope to introduce their own currency for trade settlement. That will be discussed at the next BRICS big meeting, which is in October in Russia. Russia, incidentally, is the chair of BRICS and has been driving, sort of monetary policy thought for BRICS. China will be the next chair of BRICS. So you can see that they've got a very firm hold on the way BRICS is developing and how trade settlement is going to occur. So all these factors seem to me to be at the worst possible time for America, when it's just entering a debt trap, driving the dollar out of use, internationally, which basically means it will be sold down in the markets. And we're already seeing this. I mean, when you look at what the Central Bank of China is doing, I keep on telling people they're not buying gold, they're selling dollars. The emphasis is important to understand. They are selling dollars rather than buying gold. And that's a process which I see continuing.
Is this a Thucydides trap on the part of the United States and BRICS, or let's just say the West versus the BRICS, as you kind of alluded to? You have all of this burgeoning debt to GDP ratios occurring within the Western sphere, and then you have this growing alliance within the BRICS. Is this what you would call a Thucydides trap? For those who may not know, it's when a power at the very top begins declining while we have an emerging power, and eventually they level out. And so the existing power, the legacy power, sees it in their best interest to start a war, conflict with the emerging power.
Well, absolutely. And this is actually a very worrying thing because in this Thucydides trap, America is behaving exactly as the good general, Greek general of all those millennia ago was predicting. They are just refusing to let go. And if anything, they are likely to accelerate the move towards war. And I think Russia and China, thank goodness, are being pretty patient about how they deal with this. So this is not good, and it is quite possible that we are heading towards all-out war. I mean, when I see, France, for example, and also in this country now talking about it more openly, putting troops on the ground in the Ukraine. This is a provocation which really brings NATO directly into conflict with Russia. And it's difficult to see how you can have that without actually a formal declaration of war. So this situation is actually getting a lot worse, and it's getting a lot more tense. I think that there is a way out on this one, and it's a dangerous one, and that is for Russia to destroy the dollar, which it can do. Russia could go on a gold standard tomorrow and expose that fiat currency for what it is, and that would be the end of the dollar, and quite quickly too. You can imagine the legion, if you like, of BRICS and Shanghai Cooperation Organization members, their affiliates and associates. We're looking at 60% of the world's population, or nations representing 60% of the world's population, turning against the dollar in one swift move. It will be the end of the dollar. It will be the end of every dependent currency, fiat currency, unless they are prepared to embrace the gold standard. I really don't see that America is in a position to do that, either intellectually or practically.
So why haven't they done that already, though? Why hasn't Russia retaliated by adopting a gold standard? Or is it something in their toolbox that they're waiting to employ should it ever get to that point? Should hostilities ever take it there?
It's in their toolbox. There are senior Russians who do understand the benefits of putting the currency on a gold standard. I'll give you an example as to why it really would be very, very good for Russia. At the moment, the central bank's deposit rate is 16%. And that's what's needed to stabilize the ruble. If the ruble went on to a gold standard, then practically for Russian banks, for example, Chinese banks, other banks, it would make sense for them to buy gold in the West, where the yield is 2%, sell it to the Central Bank of Russia in return for rubles, which linked to gold is a gold substitute, and they're picking up 14% on the way. What's not to like?
Yeah.
That is actually the way in which you manage a gold standard. You don't use interest rates to try and manage the economy. You use interest rates to manage your gold reserves. And that was learned the hard way in the wake of the 1844 Bank Charter Act in the UK, because it failed something like 3 times before they actually realized that you don't use interest rates to try and manage an economic outcome or to manage the banking system, what you do is use it to exclusively manage your gold reserves, and then you don't have a problem. So on that basis, it's very easy for Russia to stabilize her situation. And just think of the benefits. Interest rates would then decline. Russians in business would find that they can, if you like, their business calculations become a lot more profitable. It means that they will be able to cut the cost of their output and all the rest of it. I mean, it would be like another industrial revolution. I mean, it would be fantastic for Russia. And it would actually get her away from having to rely on the export of commodities in order to have a surplus on A, her balance of trade, and B, on her budget. I mean, the situation in Russia is that taxes, if you look at personal income tax, it's around about 13%. The higher rate is 15%. I mean, these are levels we dream of. Corporation tax is 25%, admittedly. The government debt to GDP is, and this is despite the war and all the financing of the battles against Ukraine, debt to GDP is only 21 or 22%. So you can see that actually Russia is in an amazing situation, and she can easily go onto a gold standard. And she has been pushing for this. She wanted to get gold, a gold-backed currency onto the agenda at the last BRICS meeting, but it was turned down by China and India. India does not want to upset the West. India is not in a position, really, to consider a gold standard because she's been in denial about gold for God knows how long. She's tried to stop her citizens from buying it. It's only recently that she started increasing her gold reserves once she realized the geopolitical situation she was in. As far as China is concerned, it's clear that China does not want to rock the boat. China does not want to poke the American eagle, as it were, by overtly being responsible or partly responsible for the collapse of the dollar. So while China has made contingency plans against that event, she's going to await developments, I think, before she takes a move to protect her own currency. And when she does, it's almost certain that she will also put her currency onto a gold standard.
Here's another. Yeah, go ahead.
I'm sorry?
No, I was saying, I'll let you finish your thought. I didn't mean to cut you off.
Yeah, no, that's not at all. I mean, also, you see, you've got a sort of the happy band of brothers, if you like, going into that lot. I mean, you've got Saudis who, I understand, the 50-year agreement to accept only dollars in payment for oil, that's now come to an end as of this week. So the petrodollar, sorry, the petro yuan is really going to start building. I see that continuing. In spite of Iran's terrible currency, I think the Iranians would be quite keen to stabilize her position with gold. And this is true of many other countries within the Shanghai Cooperation and BRICS ambit. It's fascinating because the problem that countries like Brazil have is that the valuation of her currency is not so much dependent on things like money supply and all this sort of stuff and the government finances. Though obviously it comes into it, but it's just purely the markets look down on these emerging market currencies. And as far as they're concerned, as far as the markets are concerned, they're trash, whether they are trash or not. So there is absolutely no benefit to a major economy like Brazil's of having a fiat currency. They would be far better crystallizing the value of their currency and putting it on an international standard, which is effectively what gold does.
So you mentioned the petrodollars agreement coming to expiration. You don't think they're going to renew it? And if that's the case, why isn't this news all over the place? I mean, you would think this would be headline news, but I rarely see any mention or talk about it whatsoever.
That's right. There's very little talk about it. It's not being renewed. It's as simple as that. Now, I've seen it from various sources that it's not being renewed, and this would actually fit in very, very clearly with Saudi Arabia's geopolitical drift away from the West, away from being an ally of America. I mean, she hasn't supplied oil to America for 2 decades, 3 decades now. Um, all her supplies. I mean, her major customer is, of course, China, and they've survived. They've signed trade agreements with China, whereby China will pay for a lot of the oil through inward capital investment into various projects, which Mohammed bin Salman has been promoting.
So what are the downstream effects of the petrodollar ending in that case? You would expect a weaker dollar on the international scale. That's called a euro dollar. You've got your international dollar, you've got your domestic dollar. A lot of exchanges in oil are made in dollars. So that would drift the other direction. But also, in addition to that, what happens to the price of gold and silver in that kind of an environment? Does it have any ramifications in that direction as well?
Yes, it does. I mean, basically, what it does is it undermines the use value of the dollar, not for US domestic purposes, but internationally. And we should bear in mind that according to the US Treasury tick figures, foreigners own in total roughly $32 trillion and dollar denominated financial assets. So they won't need to hold on to that quantity of dollars. So you can see that there will be selling of dollars. Now, the problem for the sellers is, what do they buy instead? Do they go and buy another currency? Well, I've just sort of enumerated the problems of the other central banks in the major currencies. The answer to that is no. So, if they come out of the dollar, they either go into something like the Chinese yuan, or they go into gold. And I think this is one reason why central banks who have seen this coming have been increasing their gold reserves substantially for the last 2.5 years. And that is a process which will continue. And the fascinating thing about this is, let's look at Singapore. I mean, it's rather like a canary in the coal mine. Singapore has bought enormous quantities of gold for such a small island. I mean, I can't remember. I think the population is something like 9 million or something, which is not vast. But she's got substantial gold reserves now. Now, why is she doing this? She's doing this because Singapore is run by a Chinese diaspora. They know what's going on in China. They understand the mindset. They understand the politics of China and the whole of Asia. They can see the Shanghai Cooperation Organization business for what it is, and they know that they're in a wonderful position to really benefit from this. So what are they doing? They're setting up effectively. Not only are they setting up to protect their own currency from the demise of the dollar, which inevitably will follow, and of course all the other dependent currencies, but also they will probably become the non-Chinese regional center for gold trading. I think they plan to go in that direction. And there's a guy who I got to know quite well, Shako Fan, who is the World Gold Council East Asian and central bank representative. And he came out with a paper just the other day saying that Singapore is going to be the vaulting center for central banks in the region. And I think that's a very interesting point he makes. I would agree.
So if you have this big Chinese diaspora in Singapore, why would Singapore take up that role and not a place like Hong Kong, for example, which has been the kind of like the leading economic and business hub within Southeast Asia for quite some time?
Hong Kong is controlled by China. And there will be many central banks who want to store gold in the region who do not want to have it essentially under Chinese control.
Gotcha. All right. Well, you did mention the ECB early on in the conversation. The ECB and the Bank of Canada both announced last week that they would be cutting rates, just 25 basis points in the case of the Bank of Canada there. what are some of the effects from the Fed, the U.S. Fed, keeping rates higher for longer, while you have the likes of the ECB and the BOC and all of these other central banks who begin cutting rates? I mean, obviously that portends to a stronger dollar, but what does that mean in kind of like downstream?
Well, it obviously leads to a stronger dollar measured against those currencies. Now, having said that, I think it is actually unlikely that the ECB would have announced the cut in its deposit rate of 0.25%, which is what, last week, unless it had various conversations with some of their more important opposite numbers in other central banks. And this would encompass maybe a general chat with the Bank of International Settlements. It would certainly include a chat with representatives of the Fed. So the problem I think that all these central bankers have is that even though they haven't managed to get inflation back down to that 2% level, and they daren't sort of turn around and say, well, we're going to change it to 3% or 3.5% or whatever. The problem is that the longer you have rates at this current level, the greater the danger that there will be further problems in the banking sector. And also, don't forget that the vast majority of the US economy, the European economy, the Japanese economy have all got used to the sort of rates which have allowed zombies to just take on debt, more debt, more debt, more debt, because it was costing nothing. And if anything, while you got the opportunity to take on debt, just take on debt. Businesses have been leveraged up, which something that has been undone by higher rates. So the economic consequences of the current level of interest rates are extremely serious, and the Fed will have an eye on this and be very concerned about it. So they've got this problem. How do they deal with it and inflation, the inflation problem at the same time? Now, I think that perhaps, and this is speculation on my part, perhaps a consensus is emerging that, with the US economy turning down, with inflation still continuing, et cetera, perhaps if they can sort of just muscle in a few cuts in interest rates, then consumers won't rush out and buy, sort of just put their money into goods and services and therefore drive up the prices quite so much. Perhaps a result of lower interest rates might end up taking a bit of inflationary pressure out of the steam out of the system. I can see them pushing that sort of argument, but it doesn't actually cut any ice. I mean, the person you want to listen to in America is Jamie Dimon. Dimon makes it quite clear that the outlook is very dangerous. He says he's pessimistic on the economy. And what this means is that the banks from the top downwards are restricting their lending. They cannot, in aggregate, cut their balance sheets. So what they're doing is they've diverted their lending from the private sector. And if you go around America and talk to small and medium-sized businesses and ask them about, the ability to borrow money from the banks, I mean, they will tell you in no uncertain terms, there ain't none. It's almost impossible. Instead, this money is being funneled into short-term T-bills, which has been basically funding the government's deficit. And the government's, I mean, you've had, there's a headline, a couple of months back, that the government debt increased by $1 trillion in 90 days. It's a pace that is accelerating. But the reason that it's happening is because all the liquidity in the economy is tending to go away from the private sector into funding government spending, which is non-productive and inflationary. So the inflation dragon is actually still being fueled. On top of that, with the foreigners not buying dollars and at the margin selling, as we've seen with the Chinese central bank, with the People's Bank of China, then that means that the borrowing along the yield curve is going to get increasingly difficult. And you're going to see interest rates bond yields far higher out along that yield curve. We had the same situation in Britain back in the 1970s. And I can tell you that there were three gilts, which is the equivalent of US Treasuries, issued with coupons of 15% and more in the mid 1970s. That is what happens with the debt trap when you've got continuing inflation, sort of, if you like, underpinning the situation and therefore weakening the currency at the same time. This is a situation which President Biden is making worse, and there is absolutely no sign that President Trump, or if he's re-elected as president, will actually put the situation right. I think his mindset is more sort of Reaganomics than anything else, which basically means, cut taxes, assume that that's going to get the economy going, stop the imports, which will help, sort of thing. That this is the logic. I mean, this is crazy logic, and pray it all comes right. It won't. It just won't. This is a very different time from when President Reagan was there.
Yeah, we didn't have a debt to GDP ratio of 130%.
Precisely.
Reagan's time.
Precisely.
All right. So the price of gold came plummeting down a couple of days ago, last week. The news of China ceasing their gold buying. But there does appear to be more to the story from what I've read. It appears that they may have been having trouble finding the quantity that they've been accumulating over time. So can you add more color in terms of why gold reacted to the news in the way that it did, and what more there is to the China gold buying story?
The reason it reacted the way it did had nothing to do with the price of physical gold. It was all paper gold. Paper gold is credit, which you can create out of thin air if you're a bank. If you've got a banking license, you can create gold contracts, whether it's futures or forwards or whatever. The one thing you don't want to do is to take settlement. The swaps on COMEX have got themselves very, very short. And I'm sure that there are bullion banks in the same position in the London market as well, which of course is quite a bit larger. So it has been very much in their interest because they know what's going on. They've seen what's going on. They have been confused by it, but they now find that they are in a position of extreme danger with the physical stuff disappearing and the paper markets potentially losing control of the pricing. They want to close their positions down. And so consequently, they have moved very, very aggressively to do so. And if you look at the open interest on COMEX, it has virtually collapsed from something like 520,000 contracts down to, well, I think, last night we were looking at something like 430 odd thousand contracts, which taking it as an overbought, oversold indicator is very much an oversold indicator. So, and the structure of the market has also changed against the swaps. The swaps basically have, it's mostly comprised of bullion bank trading desks, but the producers are not hedging. In the past, when you had the spike up at 1900 back in 2011, 2012, the producers were short of 200,000 contracts, over 200,000 contracts. And that, if you like, meant that the short position in the market makers was not nearly as great as it is today. So they were able to hit the market very hard, and they drove the price down from 1900 down to something like 1,050 over a period of 3 years. The swaps cannot do that today because the position in the producers is that they are net short of less than 50,000 contracts. The rest of the short side in the COMEX market is being borne by the swaps. And this is not something they can escape from. And if you look at what's been going on over the last 2 or 3 years with stands to delivery in the COMEX market, this is effectively taking physical liquidity out of the market. I mean, huge tonnages are being taken out. This year so far, since January the 1st, up to last week, roughly 253 tons of gold had been stood for delivery. And this is a non-delivery market. And compare that with the annual output of America. The annual output of the United States is around about 167,000 tons. That's the estimate for this year. Already this year, 253 tons has been stood for delivery on COMEX. That is the extent of the draining. Now, the situation for the establishment is getting worse, and they are becoming aware of this. And that is because of the massive level of savings in China. At a household savings rate of roughly 35% of GDP, that's the equivalent of $6 trillion at current exchange rates. It's not going into property. It's not going into stocks. It's going into bank deposits. And increasingly, it's going into gold. Now, $6 trillion is the equivalent of 75,000 tons of gold at current prices. So, you don't have to be the brain of the bullion bank in London to know that this is a problem. So how do you deal with it? You've got to close your positions down. And that also means where you've got unallocated gold accounts with the bank's customers, you have got to close those down too as well. The one thing that your Treasury Department in the bank will not permit is for you to load up on gold because, banks are not in the business of owning stuff. They're in the business of dealing in credit. And, if you've got a position, just close the bloody position. Don't go out and try and buy gold. So you can see that there is a hell of a problem, which is built up over a long period of time through habit as much as anything else. The bullion banks have been able to control the market basically by flooding the market with gold-denominated credit. Whenever the buyers come in, it just takes the buyers out. Buyers get tired, and then suddenly you bang it and you take out all their stops. It's a wonderful game, so long as nobody actually stands for delivery. That, however, has come to an end, and it's also coming to an end quite dramatically in silver. So that's the background.
You have this big currency reset coming down the pike. What does this spell for gold and silver? What has history taught us about past currency resets? What happens to the price of gold? What happens to the price of silver? What happens to commodities during these times?
Well, I think that, Danny, the description, what happens to the price of gold, is actually looking at it the wrong way around. What happens to the purchasing power of your fiat currency? Yes. Because the purchasing power of gold and silver sort of more or less remains. Obviously, it's not constant. It's moving all the time, but it's a lot more stable than that of a fiat currency.
Right.
Now, I'll answer your question another way. This was in the autobiography of an Austrian writer. His name comes back. Anyway, he wrote about the inflation in Germany in 1923. And at one point, you could go out and you could buy a 6-bedroom house in a swanky part of Berlin for $100. Now, the US dollar at that stage was at 20.67 to the ounce. So, you could buy a 6-bedroom house for 5 ounces of gold. I think that answers your question.
Yeah. You could buy a nice toga 2,000 years ago with an ounce of gold, and you can buy a finely tailored suit in today's currency with the same price of an ounce of gold. So
that's very interesting because I had a look at Diocletian's edict on prices. For those who don't know, Diocletian was the emperor, about 250 AD, 60 AD, something like that. Who saw the purchasing power of the Roman currency at the time collapse. And so he put in an edict of maximum prices. I'm waiting for politicians today to do that when they find that inflation starts rising and interest rates with it. Anyway, that we'll pass on that for a moment. But the fascinating thing is that there were quite a lot of items in his edict which haven't changed very much in terms of price between then and now. quite a lot of the edict was about the price for slaves, different classes of slaves and all the rest of it. We don't have a slave market to make the comparison today, thank goodness. But everyday things like beer and food, that sort of thing, and as you say, togas and so on. Coats, boots, army boots, these things are, they haven't changed hugely. My colleague at Gold Money, James Turk, put together a very interesting chart looking at the price of oil measured in gold and the price of oil measured in dollars. And I mean, the volatility measured in dollars and also other currencies was just staggering. Well, we know that it's been up to 140, and at one stage, in I think April 2020, it was even a minus figure. But in gold, it's more or less the same price as it was in the early 1950s. When at the time it was $2.50 a barrel or something. I reckon that the price has probably in gold is fallen about 20-30%, something like that from that time. And the most it's been has been sort of double or 2.5 times, and the worst it's been is sort of half. That's stability, certainly compared with pricing it in fiat currencies, which have just been crazy.
Do you see the price?
And incidentally, the Saudis will know this too.
Yeah. Well, what about silver? So gold is a holder of value. Silver, will it trace gold's or will it behave in much the same way that gold does in these currency resets, or does silver kind of pave its own trail?
Bit of both, really. It's fascinating because silver really is entirely an industrial metal. I mean, if it was being priced as money, then the gold-silver ratio would be back to where it was at the time of Sir Isaac Newton or whatever. I mean, we'd be looking around about 15 times, something of that order. As it is, it's 78 times, so it's not priced as money at all. But the fascinating thing is that when gold rises, it rises twice as fast, or nearly twice as fast on average. The problem is that when gold stops rising, it tends to fall. But then it's very much a manipulated market. I reckon the Chinese have controlled the price very effectively for some considerable time. But they're losing that control now because the Indians are coming in with industrial demand big time to offset their carbon footprint with coal-fired power stations and all the rest of it. The government policy has been to support, subsidize, encourage large industrials in India to produce photovoltaic cells. And Reliance Industries, which is one of the big conglomerates, opened its first 5 gigawatt production facility in March. Now, I reckon that a lot of the standing for delivery that's been going on on COMEX has actually been Reliance Industries and its competitors, because where else do they get the silver? It's just not there. It's taken out elsewhere. I mean, I think we're looking at the third or fourth year of a deficit of supply compared with demand. So they're drawing down on stocks the whole time. And so the liquidity has gone from the market. And I think, so what I can see is that the price for silver will go considerably higher as this trend continues without considering monetary factors at all. But if you look at the traditional relationship between gold and silver in the market, then market operators, I think, will tend to move the two in tandem because they've always done it that way, and that's what's going to happen. So it's a fascinating situation. Copper is another one which is interesting because that was also a monetary metal. No longer. I mean, I think virtually every country which had copper coins has, replaced it with cheaper alternatives, aluminium in some cases. Yet who's been hoarding the copper? I mean, China has been hoarding the copper. That's the fascinating thing. And one wonders why. Because they've been buying copper in larger quantities than they actually consume. We don't know how long that's going to continue, but You can see that there are these games going on in commodities, which mean that the whole of, if you like, sort of government's approach to commodity stockpiling and all the rest of it is changing, and it's coming back rather than going away. I mean, in the bad old days, excuse me, in the bad old days, back in the sort of 50s and 60s, America used to stockpile huge quantities of strategic metals, including silver, by the way. But they stopped doing that a long time ago. But that does seem to be coming back. It's coming back particularly in China and I guess probably some other allied countries like India.
There's a cliche that I'm sure you've heard, and that is Dr. Copper is kind of like your leading indicator of the health of the economy. Yeah. Is there any weight to that, or is just or is that just simply a cliche that's kind of run its course?
No, there is a lot of sense in it because in the same way as, we can't exist without oil, oil demand, if you like, is a very good substitute for really understanding, what's going on in an economy or in the global economy. The same is true of copper because it's central to things like power generation, the whole of the EV thing, along with silver, obviously. And, China has this dream, let's call it a dream, to basically industrialize the whole of Asia. And that does mean bringing things like communications, electricity, and all the rest of it, electrification of railways and so on. So you can see that the demand for copper from just China's, if you like, really significant plans to industrialize the whole of Asia, the copper story could be a very interesting one. But I mean, it's not going to get there in one leap by any stretch of the imagination or over an even course. It will fluctuate. And it does depend to a large extent to what point China sort of suddenly thinks, well, we've got enough copper for now, because when it withdraws from the market, I think that the price of copper could actually come off quite sharply. But that's just a personal opinion. I mean, stockpiling is certainly something we're seeing at the moment. And, until we know otherwise, assume it will continue.
Yeah. I mean, to me, it just seems this is more of an inevitability. Now, do I know when it will happen? The answer is no, but you do see the tides beginning to turn towards the precious metals market. And on this channel, we have Miles Franklin as our sponsor for this video and others. And if you email them at info@milesfranklin, you'll get the very best deals that you will see anywhere else. Email them at info@milesfranklin and tell them that Capital Cosm sent me in the subject line. And they'll send you the price guide, and you can kind of look at that and make a decision on your own. No commitment necessary. Alasdair Macleod, thank you so much for coming on, my friend, for the first time. Before we wrap up, any closing thoughts and comments for the audience?
Well, yeah, I think one very simple summary, and that is get the hell out of credit, because credit is collapsing. If you're going to get out of credit, just think where you got to go. The only place to go is legal money without counterparty risk. That's gold, silver as well, still in that role, but not being priced in that role. I think copper, I would say, is probably a long way from ever being in that role in modern times. But certainly gold and secondly silver is your escape from collapsing credit values.
And where can people find you, Alasdair?
The best place to find me is on my Substack. So, Google Macleod Finance Substack or go to alasdairmacleod.substack.com and you'll find me there. And I do encourage anyone who is developing an interest in gold and silver in particular, and the economics and the geopolitics behind it all, to consider subscribing, because it could be a lifesaver.
Excellent. Well, if you guys enjoy this content, remember to give us a like, comment down below whether you disagree or agree with any of our takes here. And as always, be sure to subscribe to the channel if you haven't already. A ton of you, it was 85% as of last week. We've managed to get that number down to 80%. 80% of you who watch this content are not subscribed to the channel. Let's change that ratio to the opposite side. Subscribe to the channel if you're getting value so we can keep getting guests like Alasdair on the show. And with that said, you guys, I will see you in the next episode. Bye, y'all.